Knowing what kind of investor you are is incredibly important to managing your pension and getting a good pension return. There are four types of investors, and you often don't know which category you're in. So it's important to work that out. My job is to help you work that out. And then once you've worked it out, you can have the right kind of investments to suit you and get the growth you've not been getting through an IFA or a wealth manager, because they don't go through this process. They lumber everybody into one group. So the first type is the worrier. The worrier feels that holding stocks for 12 months is way too long because they're worried. They don't like the drops holding a single stock in a portfolio can involve, because a single stock could drop, for instance, 35%. And that's not bad that they don't like that. Nobody likes that, but it really particularly would bother them. They like to monitor a lot and regularly because they're a worrier, and that's fine. We've got to deal with the personality you are. So with this first type of investor, looking at their pension, the solution is they should have all of their investments, let's say, in exchange-traded funds. These are index trackers. They're baskets of stocks. They could have as many as 500 stocks in them, like the S&P 500, or even more, like a world index tracker. Or they could be thematic, like AI, or they could be style-based, growth, and so on. The characteristic of them, though, when we go through them, is we look for the ones which have a projection of 40% on existing trends, which have continued momentum in that direction, high Sortino, in other words, high average returns, low downside risk, so that they tick a lot of our boxes, and low volatility, preferably below 10%, maybe even below 8%. Okay, so that gives us high consistent returns with downside volatility. That way, they've got smoother trends and fewer sharp falls than individual stocks. And for the worrier, this is particularly attractive. And you might say, hell, why doesn't everybody do that? Well, they're welcome to. You might decide that you're one category and you want to move to another. Let's look at the next one, the constant observer. The constant observer likes to watch their pension very regularly. So in some ways, similar to the worrier. They're not likely to wait 12 months to see how performance goes. Again, similar to the worrier. They expect after 3 months to see an excellent result, maybe even after 8 months, excellent result, and they're easily disappointed. Okay, so again, not anything necessarily wrong with any of these. Now, the solution for them, because unlike the worrier who tends to be more risk averse, these guys are partly risk averse and also they want those returns. So what might be suited to them is both the ETF side, where you're looking at the 40% lower downside volatility, but equally our intermediate term tactical stocks. These are the ones where we're looking for 40% returns, but in a sooner period than 12 months, so maybe in 6 months. They might like our non-special situations, which are the ones where they're very much particularly based on momentum and don't tick all the boxes of a value, growth, income, and so on. And the constant observer, because they're constantly observing, they don't mind that so much. They can take more of the volatility compared to a worrier. Not too much more, but a bit more. That's why they have some of the ETFs. So they have that. Now you've got the mixed user. The mixed user, like some of the buy and forget for 12 months portfolio, they're fine with that. Okay. They want some extra zip too as part of their funds, and they're willing to spend a bit of time on that. Okay, now the solution for them is, again, the intermediate term tactical stocks, the hedge fund and banking non-special situations. They can have the special situations as well, the ETFs, and the regular Great Investments Program further filtered Quality 5 Plus. Okay, and why? Well, because the zip comes from the hedge fund, the non-special situations, the intermediate term. They might even do some of our leverage ones. And then the core, I'm happy with the buy and hold, comes from the Great Investments Program. The relaxed investor, the final one, they're happy to wait 12 months. They know the 25% exit. They want simplicity. This is me, by the way. Solution for them is Great Investments Program, further filtered, Quality 5 Plus, including ETFs. Sometimes I add a bit of leverage because I'm a bit of a mixed user now and again. But I'm one of those two categories. There's not a right category. For whatever category you are, we've got to find how do we get to that return. Now, if you get in the wrong category and you pick the ones which you're supposed to hold for 12 months, be relaxed with any drops, all the rest of it, but you're actually a worrier or a constant observer, you're going to end up getting emotionally distraught. You're going to end up prematurely exiting and then realizing, oh, actually, I should have held on anyway. you're going to get confused because you don't realize that it's about the whole portfolio, not every single individual stock, but the whole collective to deliver the returns. So that's a manner in which we very quickly try and identify. I say very quickly, it can sometimes take the individual several months to work out who they truly are, because what people say they are and what they actually are, as we all know, two different things. Anyway, have a look at the links in the bio, like and follow for more, and look forward to speaking to you soon. Thank you.